which is what they wanted it to be originally. So all new mortgages that are taken out after December 15th of last year can only be deducted to the up to $750,000. And this money has to be used to buy, build, or improve your primary residence and or your second home. So your ski chalet, Crystal, that would count, or your beach property for Kayla, okay? So that's the limitation. Now, yes, sir.
I had a question on that.
I love questions.
The $750,000 could have part of the house be owned by a corporation?
If part of the home is owned by a corporation, we have a little problem there because when you go to sell a house, that part of the gain will not be excludable. So I'm not sure why somebody would do that. You want to come and see me afterwards and we'll talk about it. Oh, it's working? Thank you. Thank you so much. Okay, we'll go back. Yes, it's working. It's working. Come see me afterwards. I might talk you out of that one. I'm not.
I was asking, with houses going for $900,000, tear down to 1.2.
Mm-hmm. Is it an investment property or is it a private residence? Okay, investment properties are different. This is the law just for your home, your primary residence, and your secondary home. The interest is limited to how much? Exactly, $750,000. They did not change any laws on investment properties, maybe because the president is involved in real estate, I'm not sure, but they didn't change the laws on that one. Okay, HELOCs, which is what I was talking about earlier. Now, you HELOCs, my little rookies, what's a HELOC? Home equity line of credit. They call them equity lines. They can call them a second mortgage. You can call it anything you want, but it is no longer deductible whether you took it out 10 years ago, last year, or this year. Only if the money was used for one of three things: to buy, build, improve your primary residence, where you sleep 5 days a week usually, and also your second home. That's it. So if you have a home equity line of credit that you took out and you used the money to pay your child's college tuition, or you paid off credit cards, or you bought a car, it is no longer deductible, period. Okay. Actually, if you took the money out to buy a car and that's a business use car, there's a way we can deduct the interest, but it's not going to be as a personal, it's going to be as a business expense, which would be a loophole. Okay? Moving expenses. Do any of you move with people who are, do any of you work with people who are moving into the area or moving out of the area? Okay. They can no longer deduct their moving expenses. Moving expenses incurred or paid after, or being paid after January 1st, no longer deductible. Now, does anybody here have a child age 16 or under? Okay, 2 of you do. You do get an increase in the tax credit. You can no longer deduct the children for any reason, but you can take a tax credit of up to $2,000 per child. They must be age 16 or under, and your income has to be under some certain amounts, okay? So they did double that amount. That was a good one. The medical deduction, I'm going to talk about that one later. Because normally, can you claim medical? Say no. No. I'm going to show you a way that you can. Okay? It's a huge deduction. Yeah, 10% of your income starting next year. Yeah. 7.5. Yeah. Let's say that you make $50,000 a year. If your medical expenses are $3,750, you still claim nothing. If they're $4,000, the most you could claim would be $500. No good. I'm going to show you the loophole. Huge loophole. You'll love it. Okay. There is no Affordable Care Act mandate. You do not have to buy any health insurance starting next year. So if you don't want to have health insurance, fine. Don't have it. You don't need it. You'll be very happy to know that the Congress, when they changed the law, they took care of the very wealthy people. Did you know what they did? They say that anybody who has $11 million if they're single or $22 million if they're married, they don't have to pay any estate tax. Wasn't it nice? They took away your deduction for your children, but they gave them the estate tax exemption. Yep. You can see what I think of the law. Now, for businesses, we're going to talk about a 20% deduction. Anybody who's self-employed, and this means they can be self-employed on a Schedule C, you can be a limited liability company, or you can be an S corporation, you'll get a 20% deduction off the top of your income. Okay? So remember, we had Andy over here, who was the rookie. So what was his net income from real estate? 40. What's 20% of 40? That's right. So he would get an $8,000 deduction starting this year. It will not save any Social Security tax, though. It's only a deduction against federal and state tax. You can, it's called the pass-through, 20% pass-through. Yeah, this is, and it's going to be very complicated to figure out because it's based on a number of things and it depends on your occupation, but if you folks do qualify up to a certain amount. Now, the next part I'm going to tell you is a very bad thing they did, but I think it's going to get changed before the end of the year. So make sure you rip off the first page and you give me your name and your email address because I will let you know the minute I get this law changed because I'm going to try to do so. They have disallowed the deduction for any entertainment whatsoever. That means if you take a client out or if you want to entertain them, go to a sports event or a movie or go to the Kennedy Center or something like that, it's not going to be deductible. That's what they say. Now, I have a feeling that the real estate lobby and the restaurant lobby are going to fight this. I know I am. So it may be before the end of the year, you'll get a little email from me and I'm going to say, I fixed it. Okay? Yes. Entertainment includes any kind of entertainment unless you're out of town on business. Now, if you hire your spouse to work for you, that's a loophole. And we're going to talk about hiring your spouse in a minute. Okay? Yes. Nope. Yes. You need to get a spouse. Oh, no. Okay, here's the pass-through business entity thing. The deal says that if you are single and your taxable income after all your business and personal deductions, if your taxable income is less than $157,500, you are allowed to take this 20% pass-through entity deduction, which will save you only federal and state tax, but it's better than nothing, right? Now, if you're a married couple, your income, your taxable income, can go all the way up to $315,000, and you still will get it. If your income is over those limits, there's going to be a disallowance amount, and then eventually it'll peter out completely, okay? There are some phase outs. This is going to be very complicated. Do not try to do your own tax return. First of all, if you mess up on this, you would lose. If the person who did their own return, this one here, and they didn't get it right, they could lose an $8,000 tax deduction just for not filling out three little forms on their tax return. That would be huge, okay? Don't do it. Now let's look at an example of what the taxes look like before and after. Oh, look, we have Andy up here, Andy Agent. Yeah, Andy Agent made $90,000 this year. But he came to Tax Masters, and let's see, who should we pick? We'll have Mary. Mary in our office. Did everybody get a calendar? Show you Mary. I like Mary. Pardon? Yeah, Mary. Mary's Miss November. Oh my gosh, we need to get a new picture. This makes her look so young. Well, she is young, but Mary's one of the ladies who specializes in realtors. So Mary does your tax return. We'll say it's this Andy this time. And now you made $90,000, but Mary came up with $45,000 in business tax deductions. So how much is Andy's net income from real estate? Come on, 90 less 45 is, that's right. And Andy has a wife who made 45. Andy has 2 children. So last year he would get 4 personal exemptions, right? And he has some itemized deductions because Andy owns a home and real estate taxes. So his taxable income is how much? And his tax is that much, 7. Now, under the new law, what happens? Same income, his net income is the same. This is the same salary. Does he get any personal exemptions? Nope, they're gone. But what does he get instead? He gets the 20% deduction. So 20% of that is that. Remember last year he had $18,000 in personal itemized deductions? But what does he get this year? $24,000 standard deduction. Thank you, Reba. Reba's awake. Good. Now his taxable income is actually $57,000. Last year it was only $55,000. So his taxable income went up. Yikes. But because the tax rate went down, tax rate last year 75, this year 64. He saves $1,100. Now, don't get too excited over this, because all it would take is for Congress to change the tax rate, and what would happen? Yeah, if the tax rate went back to the old tax rate, he's going to end up with what? He's got more taxable income. 55, it went up to 57. You see that? Okay. Now, this is the way it's supposed to work. Now, nobody's even gotten, we haven't done 2018 tax returns yet, but that's what's supposed to happen. Okay. Now, let's talk about an LLC. You see the little hearts? I love LLC. LLC stands for Limited Liability Company. It is not a method of changing your tax rate. It doesn't save you any money on your taxes to be an LLC. What an LLC does is build a brick wall around your assets. So if you operate your business with Keller Williams as an LLC, and you were to get sued for something businesslike, and if the lawyer has prepared the LLC properly, then you're going to have a good chance of getting away free without losing your home, your children, your retirement account, or anything like that. So I love them. Now, you can also elect to be taxed as a C corporation or an S corporation, okay? Either of these, all of these, can be an LLC, any way you want, okay? I love LLCs. Is anybody here a landlord? You own a rental property? Yeah, I would never own a rental property that wasn't in the name of an LLC. So let's say your property's on Main Street, just call it Main Street LLC. And then if something, God forbid, goes wrong and you get sued, the most you can lose is your equity in that one property. They can't take anything else, as long as it was prepared by a proper lawyer. Now, let's talk about cars. Oh, let's talk about Rob's car. Rob's been such a big help today. Okay, Rob's going to tell me that he drives his car 20,000 miles a year, and that's his 100% of his driving. Now, Rob says that 2,000 miles a year, he's having fun. Rob, what are you doing the other 18,000? Working hard with Keller Williams, who I love. I told you my daughter owns the Keller Williams franchise. That's not the name of it. What do you call it? She owns the whole market center. Thank you, for the whole country of Belize. Okay, so you work hard and you spend 90% of your time in your car showing property, visiting properties. Now, you have two ways of deducting your car. On these forms that I've given you, you can see all the juicy things. You can deduct your warranty, your inspections, your car washes, the interest on your car loan. Those of you who are rookies, don't forget the interest on your car loan now becomes a business expense. And because you're in Virginia, the personal property tax on your car, don't take it anymore as a personal expense. You're going to move it where? To the business portion. That's exactly right. So you have a choice. You can deduct all these expenses, including the interest. Okay? But maybe Rob says, no, I'm lazy. I don't want to keep track of all those expenses. I say, it's okay. So handsome. We'll forgive you. We will let you take the other way. Now, the other way is taking the mileage. So you're allowed to take your mileage times the cents per mile. But guess what? You still have to claim 90% of the personal property tax on your car as a business expense, and 90% of the interest on your car loan. Oh, you like that? Yes. So no matter which way you deduct your car, you always get what? 90% of the interest on the car loan and 90% of the personal property tax. This is very important. Many of my clients own two cars. I have clients that are single that own two cars or married. And a lot of times my clients will say, well, I'll just claim 100% of one car for business and I'll use the other car for personal. I say, no. Don't do that. Don't do that. Because no car is 100% business. So what we do is we'll take 80 or 90% of one car and then 30 or 40% of the other car. Now, which is more, 100% or 80 plus 40? Yeah, do it my way. Do it my way. What does it say over here? What does it say? Okay? I will only tell you to do things that are good for you. I don't need your money. You don't have to be my client. I just sleep at night because I want to help everybody. Save as much money as possible. Okay? Do what I tell you. Yes. That's an excellent question about which one is better. I encourage my clients to do the best they can. But if you come to me and you don't have your records, I could sit down with you, and as soon as I know how many miles you drove, I can figure out how much mileage you get per gallon for the car. You know how much you spent on your insurance. You know what your repairs were. We can reconstruct it in minutes. I can come up within $500 or less. I'll come up with exactly what you spent because that's how good we are. Okay, it's always good to try both ways, and you have to be very careful. The first year you buy a car, if you set it up the wrong way, you're kind of stuck with that. So you make sure you go to someone, especially when you buy a car, you go to someone who knows what they're doing, so that it's the first year it's set up in a way that you can either wiggle back and forth or it's done properly. Yes, sir.
They didn't touch the section 179.
Very good. They didn't touch the 179 deduction. You're still allowed to get a $25,000 deduction if you have a business car that weighs over 6,000 pounds gross vehicle weight rating. Now, nobody uses a car 100%. So let's say you bought a nice Lexus or you bought a nice Toyota Land Cruiser, or you kind of look like a Cadillac Escalade kind of guy. Okay, so if you bought one of those, then we could at least take 90% of the $25,000. And there's also bonus depreciation and some other things too. Yes, yes, it can be a used one also. Absolutely, absolutely. Yeah, you still have to put gas in it though. Okay, let's go to the next one. Everybody say a big thank you, Linda. Okay. This law is very close to my heart because I helped get it changed a long time ago. There used to be a law that said you can't claim an office in your home if you have an office elsewhere, or unless you see clients in your home every day, or it had to have a separate entrance, or it had to be a separate building, or when you sold your house, you had to pay tax on the gain. I want you to forget all those things I just said. In 1999, the new law says anybody who is self-employed, who uses any space in their home, say the magic words, can deduct an office and home. It doesn't matter if you pay rent to an office somewhere. I have a client, he's a doctor. He pays $30,000 a month rent for his office on K Street. Okay? We deduct his office in his home. He's got a big office. Okay? Okay? We deduct his office in his home. Okay? I have a lady who's a client who lives not Williams. Since 1999, I've been deducting 55% of her home for business. She lives in a Rambler, so the whole lower level is what? 50% of her house, right? And that's what do you think is down there? Her office, that's right. And because now she's getting up in age, she uses one of the upstairs bedrooms, the littlest upstairs bedroom. She keeps her signs and supplies up there so she doesn't have to, carry them up and down the stairs. Since 1999, I've been deducting 55% of her home because she uses it what? Regularly and exclusively. She's not with your office here. She's with another Keller Williams office. Yes, 55% because it's a Rambler. And the Rambler is on 2 floors. And the whole lower level. Now, she used to have the laundry room down there, but I had her move a laundry up to the mudroom. Hi, welcome to class. We're talking about one of my favorite things, because I got it changed, the office and home deduction. Yes, you know why I love it also? Because now you can claim more car expense. Because if you have an office in your home, your first trip out of your driveway is what? Business trip. I'll use myself as an example. You folks, you may have seen me. I'm on CNN. I'm on C-SPAN, ABC, NBC, CBS. I've been on every radio and TV show around NPR. Oh, my God. What else, Amanda? Sirius XM. Yeah. On Saturdays, sometimes I'm on Sirius XM radio. And I live in Bethesda, so I get up on Saturday morning and I play with my little laptop, and then I jump in the car and I drive to Eckington Place Northeast. That's where SiriusXM is. And then I drive home. Can I deduct that trip? Yes, because I left from my home office. But if you don't deduct a home office, don't even think about deducting 80 or 90% of your car for business, because you will get audited. We're handling audits right now. Our clients don't get audited. And I told you we do 3,500. Is that? No wonder I'm tired. Well, I have 20. No, there's 20 people in my office. They do all the real work. I just talk. Okay. For all of the realtors, and like I say, we do over 2,000 realtors, these people get to claim more car expense. But we're handling audits right now for realtors who do their own tax return. Say boo, 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 boo. And you know why they got audited? Because they claimed 80 or 90% business use, and they didn't have an office in their home. So you know what happens? IRS looks at their return and said, oh, there's no office in home in here. And they think they can get away with 80%. Let's audit them. And the best thing is, on the back where you're supposed to sign, it only has the person's signature. And where it says paid preparer, there's nobody there. And they say, look, these people were smart enough to do their own return. That means they're smart enough to cheat. They don't have anybody to defend them. Let's get them. Okay, so watch out. Be careful who signs your tax return. Now, any questions on office and home? No? Yes, Rob. You and your wife have a couple spaces. Is she also self-employed? She works from home, but she's an employee. Oh, does she ever help you with real estate? Okay, not yet. Maybe she will. Because that's the next thing. This Andy's got a question. You would not want to add the garage. This is a good question, because that would make your house square footage larger. We want the usable square footage to be as small as possible. When I'm measuring your house, I want the legal description of your house. I can look it up online. I'm going to take out the stairwells. I'm going to take out the corridors. I'm only going to take the usable space, and then we're going to measure the space that you actually use. And that makes it as a normal amount. Now, the average realtor uses their home 6 to 10%. It's very rare that somebody's 55%. Only because the lady is single and she has a Rambler, and that's how we do it. Okay? All right, so office and home is really good. Now, normally, can you deduct medical bills? Say no. Say no. No, because in order to deduct them, they have to exceed a certain percentage of your income, right? And starting with the new law, it's going to be 10%. So let's say, remember we had the example over here of Andy and Emma? Where did I put the little thingy? And what was their income? 90,000? 45 and 45 was 90? Okay. So they have 90,000 income. What's 10% of that? Okay. So if they have $8,000 in medical, how much can they deduct? Zero. If they have 10,000 in medical, how much can they deduct? Now, is this very good? No. Under the present law, the one that you only know about, you have to be very sick or very poor in order to claim any medical. I want you super healthy. Yeah, you look at, and I want you filthy rich. Okay, so forget the poor and the sick. Here's what's going to happen. You're going to listen to me, because 60 years ago, Congress did a good thing. Now, how often does Congress do a good thing? Come on. Yeah, okay. Well, 60 years ago, they did. 60 years ago, Congress said that, you know what, husbands and wives who work together, they're kind of like a little company. And if you work for a company, can you deduct or have them deduct for you your health insurance and the medical reimbursement plan? Yep, of course you can. Now, if you're single, don't worry, there's a way around this one too. Who was Congress trying to help? Actually, it's almost 70 years ago. Huh? Who? Yes, farmers. Because what happens on a farm? Husband and wife work together. The wife, she milks the cows, right? Is that like milking the cows? And the husband, he slops the pigs, right? Or he tills the soil. So they're like a company. And it was also mom and pop stores too, but mostly it was the farmers. Okay, so 35 years ago, I'm in class, night school. I was in night school studying taxes, and the professor is talking about this section of the IRS law. And I woke up at 2 o'clock the next morning because I was already a realtor. I was already divorced and everything, already working in real estate. And I went back to the professor the next day and said, Professor, do they have to be a realtor? Excuse me, do they have to be a farmer? Can they be something else? The professor said, no, they can be anything that's self-employed. As long as the husband and wife work together, and there's an exclusion for single people, don't worry, we'll get to it. So I thought, you know what? My clients are realtors. I'm a realtor. I am a realtor. I don't do it anymore. I said, this works for realtors. Don't you farm neighborhoods? Okay. So all that has to happen is the spouse who's working, the self-employed spouse, hires the other spouse to help them a little bit, part-time, just part-time. Doesn't matter if the spouse has a regular job. I have a client, she's a realtor. Her husband is one of the directors of the World Bank, for God's sakes. Okay, and she hired Cedric, okay? Now, that's his code name. He's got another name. Anyway, this makes all of your medical bills deductible. Now, who here is married? Put up your hands. Okay, very good. What's your wife's first name? Evelyn. Now, does Evelyn ever help you with work a little bit? She does. What does she do? But she helps. Of course she does. You're so handsome. She's not going to let you go out at night and show properties alone. Okay, so here's how it works. She doesn't have to have a real estate license. That's not necessary. But she could be also, just a teacher. She could be a doctor, a lawyer. She could be anything she wants. She could be vice president of the United States. I wish she was. Or president. Anyway, here's what happens. You hire Evelyn. Now, she's an employee, so you have to give her a salary. You're required to give her a little salary. It starts out at $250 or $300 a year. That's a good amount. Okay. You have to pay her a month. That's right. So this means, I know she's worth more than that, but that means that your income, the income you receive from Keller Williams, goes down $3,600 a month, and her income goes up $3,600 a month. Now, you file a joint tax return, don't you? So we don't save any money there, do we? But guess what happens next? Every once in a while, Evelyn goes up and says, hey, boss, my husband was very expensive this month. He spent $400 on his new glasses. I went to the dentist. It was a couple hundred. If we have kids, if we have insurance or things like that, I need to get reimbursed. So Andy, out of the business checking account, this is the account where he deposits those big checks that he gets from Keller Williams. You write a check to Evelyn, personal name, and in the memo section, this $1,000 check, whatever, you write employee reimbursement. That's all. Now, every dollar of every medical bill that you're reimbursing her for becomes a business expense because she is your employee, and you are allowed to have an employee reimbursement program for medical bills and anything else. Now we can deduct her car, her cell phone. You can take her out to dinner. Yes, it has to be a formal plan. We charge $750 the first year to set it up. That includes the W-2 form, the withholding, everything, the contract, everything. Yes, sir.
This tees into that, and that is, you have to have a formal plan.
Yes.
It has to be consistent among employees.
Yes.
So if you have a wife,
Mm-hmm.
my wife's reimbursement plan would need to be the same for my assistant.
Do you have a full-time assistant?
Yeah.
You have a full-time assistant? Yes. You would have to do the same for any full-time employees. Okay? No. Part-time, no. Usually what we do is we have him hire the spouse first. Okay? And then if he hires somebody else full-time, they have to be with him for, I think, 3 years before he has to do the same thing. And if you have somebody who stays with you for 3 years, you'd want to do the same for them, too. Yeah, it's a good thing. Yes, Reba?
Does it fall into the same category you're reimbursing, say, or you employ, say, your 16-year-old child?
You can hire your child to work for you. You can listen. Do you think my grandchildren? 6 of these are my grandchildren. None of them. Yes, yes. Now, you can reimburse them for their personal medical bills. It won't get your medical bills because they file a tax return with you on it. Whereas when he's reimbursing Evelyn, he can reimburse Evelyn for her husband's medical bills. Okay, but the child, yes, I have 2 children. I have 3 children, and when they were in college and they used to take business courses, I paid them for their college and I paid them for research. And then 2 of my children went on to law school, so of course I could reimburse them for that too. Yes, for legal research. Now, all you do, yes. Yes, okay, so if we're not married, we have to make you a C corporation. We're going to say you're the Andy C corporation, and you say, you know what, I'm president of my C corporation. I think I should be able to deduct my car. Let me sign that. I think I should be able to deduct my phone. Write that down. Oh, I think I should be able to deduct all my medical bills. So we sign a contract, you with you. Okay, it's very formal. It's a full contract. We have to prove you're a U.S. citizen. There's a whole bunch of paperwork. That's what we charge for. Now, every medical bill that comes in through the door from that day forward is paid for off the top out of your corporation. Saves you federal tax, state tax, Social Security, and Medicare. Saves you all 4 taxes. You too, 4 taxes. So if you even had $2,000 worth of medical last year, you just saved $1,000 in income tax. And of course, you have to pay us the first year, $750 to set it up, but that's deductible, so it's going to cost you $375. So for a $375 deduction, now every medical bill you have is fully deductible. This is the most overlooked tax deduction in the whole tax code. There is no other deduction that is available to so many people that they don't use it. I have, in the past 36 years, 45 years, I have set up more of these plans than anybody in the United States of America. Yes. It can be an LLC. This is a C corporation. But if you're single because you don't have the spouse, yes. No, because he's single. Because he's single, he has to give his employee the benefit. No, he's not. No, he's not paying any tax because it's all coming off the top. No. Do you think I would have anybody pay double tax? Yeah, but it says, no, because we're going to, no. Come see me afterwards. No, not happening. I have not, it would be against my religion for a client to pay double tax. No. You can be an LLC, you can be a sole proprietor, and you can be a C corporation. What you can't be, I don't think, is an S corporation. It doesn't work as well. Okay, now listen to me. Yes.
So for the amount that's coming off the top, that's just the portion that you were responsible for.
Yes, that's right. Whatever you paid out of pocket. It's all of these things here. Your health insurance, dental insurance, long-term care. Let's say that one of you has a spouse who's already on Medicare, so you can reimburse them for their Medicare. If you have a spouse who's retired, when your wife retires from teaching, she'll retirement check. They'll probably take $500 a month at least out of her retirement check to cover the family's health insurance. You can reimburse her for that as a fully deductible business expense. Saves you federal, state, Social Security, Medicare taxes. Most overlooked tax deduction. Long-term care, you can deduct everything, deductibles, co-pays, prescriptions, dental, vision. You can reimburse your wife for condoms. You're supposed to laugh. You can reimburse your wife for Band-Aids, sunscreen lotion, diaper rash ointment, anything that's vitamins. I take a lot of vitamins. My doctor prescribed them. I can take them. Okay. Everything becomes a business expense. Everything comes off as an employee benefit. Read this out loud. Yeah, it's actually more than that. Okay. Marty Wapner. He's Mr. May in there. He's the one who sets them up now. I don't do any work anymore. I just talk. He's an enrolled agent. He sets up these plans. He set up more of these in the past 10 years than anybody in the United States of America. Okay? That's it. Next plan. We live in the most wonderful, powerful country in the whole world. Everybody say yes. Yes. Don't argue with me. I was born on the 4th of July. I love my country. I may not like the new tax law too much, but I love my country. Okay, our country. Sorry. In this wonderful, powerful country in which we live, 95% of every presently retired person today cannot survive on a month-to-month basis without a check from welfare, their church, their children, or Social Security. Now, when you retire, are you counting on that welfare check to help you? How about your church? They're going to send you a little check every month. How about your children? You want your children? No, no. Until they get as old as mine, it goes the other way. Now mine are the other way around, thank God. Okay, how about Social Security? 10 years from now, every Social Security check that's received, 50% of it's going to go towards paying your prescriptions, just your prescriptions and medical bills. 50%, so don't count on it. Now, 18 years ago, Congress did a good thing. It passed the 401k. Now, does anybody here have one of these? Just two of you? That's all? Just two? Nobody?
You said you have one of those. You mean one of the top ones?
Any of those? Sorry. Any of the first four? Okay. 18 years ago, Congress passed a law so you would never use an IRA or a SEP if you are self-employed. Okay? They passed a law saying that everybody who's self-employed is allowed to have a solo 401k. It costs $150 a year, or you can pay more. Okay, I don't sell them. I'm just telling you how much they could cost. Now, because I don't want you to say you can't afford it. These are unqualified plans. Many of you probably worked at a company where you had a 401k, right? Did you leave it behind when you left the company? No? Okay. Well, in any case, don't leave it behind. I want you to roll it over into your own 401k. A 401k, the reason why I like it, let's read this out loud. The first sentence, what does it say? It is. Thank you, Reba. Read it again all together. Okay. The other accounts that I just told you about, the SEPs and the IRAs, they're not qualified plans. They're not federally protected. Okay. Also, these plans, the 401k allows you to put more money in if you want to. You're also allowed to borrow from it. So you're so young. You don't want to put money into a 401k, or you don't want to put money into a retirement plan because you think it's going to be there till you're 59 and a half. No, you could put it in your solo 401k today and borrow it out tomorrow for any reason. You want to go shopping? You can take it out. If you want to take it out to buy a Harley Davidson, you can take it out. You want to take it out to buy a boat? You can take it out. Don't do it if you're my client. I'll fire you as my client. Okay? When you borrow the money out, what happens? You can be over 70 and a half. You can be 102. And if you want to contribute to it, you have until October 15th of the following year. Now, if you want to put money in, fine. This is usually when you have to start showing a profit. But you folks who have them, you should immediately, in my opinion, roll them over into your solo 401k. So at least they're federally protected, number one, and you can borrow from them, number two. Especially if you're a rookie and you're starting out, you might want to have some money out as a loan to live on. So your big commission checks from Keller Williams start flowing in. Now, how much can you put in? You're allowed to put in what? 20% of what? Okay. Remember we had the rookie, our little rookie. Was that Andy? Was Andy our rookie? Okay. And what was his income? He made his first year, he's the rookie of the year. He made $60,000. How much were his business deductions? So his net income was 40. Did he make at least $18,500? Okay, so he could put that in. What's 20% of this? Can he put that in? Yep, he can put that in. How much is that? Out of that much money, he can hide this much. You might want to think about this because you can live on your wife's salary. Also, if he was over 50, just for today, we'll make him over 50, he can put in an extra amount. So how much out of 40,000 you can deduct off the top of your income? How much money? Yes. And is it tied up till he gets old? No. When can he take it out? He can anytime he needs it as a loan. Now, when you take it out as a loan, for any reason, you have to pay it back in 5 years. Okay? But if you take the money out to buy your home, your primary residence, you can pay it back over 15 years, which brings me to something really interesting. How many of you have clients that are self-employed? Put your hand up. Put your hand up. Put your hand up. Put your hand up. Oh, come on. Come on. I like obedient. Put your hands up. Thank you. Thank you. Okay. You all have clients that are self-employed. They might need to borrow money from their what? To buy a property from you. Oh, did you think about it? Okay. Here's how it works. What's your first name? What's your first name? And another Andy. You weren't just kidding. You're the third Andy in our class. Okay, you weren't here today, so you didn't know about this law. And guess what? You have a nice new client, and they're getting ready to buy a home, and you've just informed them how much money they need to bring to the settlement. Guess what? Not good news. They are $10,000 short. I mean, it could be $50,000, but we're just going to use 10 as an example. They're $10,000 short. And what do they do? They're desperate. They want this house from you, Andy. They really are desperate. So they walk into their stupid bank where they have their stupid, unqualified what? And what do? They withdraw the money. What happens when you take money out of your SEP or your IRA? Immediately, right? How much tax do they have to pay to the federal government? How much? Well, if they're in the 25% bracket, how much do they owe? If your client was in the 30% bracket, Andy, how much would they owe here? 30% times 10,000 is? Yes, it could be more. Now, your client, let's say they live in Maryland, okay, or they could live in Virginia. What's 8% of 10,000 or 6% of 10,000? Yep, okay. Oh, guess what? Your clients are under 59 and a half. There's a 10% what? Yeah. How much today, right now, do they have to pay? Yeah. Will they ever get that money back? It's gone forever. How much is left to bring to the settlement? Oh, you're going to lose the deal. It's against my religion. I told you, over 30 years ago, I was a realtor. I did really well. I did commercial and industrial real estate. I sold a medical building twice, and that gave me enough money to start my company, Tax Masters. But I remember being a single mom and supporting my little girl. No help from first husband. Don't get me started. I've been divorced 5 times, so I didn't learn too well. But anyway, here's the deal. This is not going to be allowed. You are not allowed to lose a commission. I know how important commissions are to realtors. I was there. I've been there. You are so lucky you came to my class today, aren't you? Yes. So here's what happens. You tell them to call us or somebody who knows what they're doing because they have a stupid account. We would have them roll the money over to their what? And they borrow out the 10,000. What happens when you borrow it out? It's a loan. They have to pay what? Okay. 5%, that's the legal amount on the unpaid balance. It's to buy their home so they can pay it out over 15 years. But it's interest only. Now, to whom are they writing the check for the interest? Yeah. So what happens to their 401k? What happened to their IRA over here? Killed, dead, gone. How much is left to bring to the settlement? Put your hand up. Put your hand up. Who gets his commission?
I do.
Okay, we do this all day long. Several times a month, one of our 2,000 realtors calls us up and says, we need to do that K-plan thingy. Of course, I have them talk to Amanda, and she sorts it all out because she knows how to do those. Yes, Andy? Doesn't show up anywhere. I told you I have 3 children. My older daughter, Macarena Rose, who owns the Keller Williams for the whole country of Belize. And then there's my son, Preston, who runs the company. He's Mr. September here. And then my younger daughter, Gia, who also went to law school too, but he decided he'd rather run my company than be mean lawyer. So my daughter, when she went to law school up in Balmer, did I say it right? Balmer? Did I want to pay rent in Balmer for 3 years while she was in law school? No, I borrowed $35,000 from my solo 401k. I bought a little end unit townhouse off of Jones Falls Parkway for $135,000. We owned it from 2001 until 2005 when I got her to move back to Bethesda. By the way, she passed the bar the first time, youngest one in the room. And guess what? I sold it for $210,000. Good timing and good deal that I had the money in my 401k. Yes. So if you have kids going to college, buy a little place, put them in there. And she rented it out and it covered all the expenses the whole time she was there because she rented it to some of her kids from law school. So every one of you, if you have a 401k, you can borrow from it to do what? Yeah, but don't you buy that Harley Davidson or the boat, okay? I will fire you. You can't be my client, okay? You can only take the money out to buy real estate, okay? If it's your home, if it's your home. If it's something else, 5 years. Yeah, I just had a client who's a realtor, not with Keller Williams, somebody else. She called last week and she had some clients who were going to borrow $25,000 out of their 401k to help their child buy their house. And unfortunately, I told them, no, you got to pay it back over 5 years, but they didn't figure that's a problem anyway, because it wasn't their home. It was a home, but it wasn't the home they were going to live in. Okay, I'm opening it up for questions. Yes, Andy, number 3. 1, 2, 3. It's okay. Send me a copy of your last year tax return and I'll tell you. Usually we don't like to play the Social Security evasion game until your income is $150,000 a year, and then we might go to a schedule subchapter S corporation. However, I always recommend everybody be an LLC. Can't go wrong. If you look at any business card of any lawyer, my daughter Gia, her business card is Gia Shepherdson Esquire, and then what do you think the next 3 letters are? Yes, every lawyer is an LLC. TaxMasters is an LLC. It says TaxMasters Inc., but it's an LLC. Okay? Yeah. It's the same protection, though. Yeah. Come on, there should be some questions about 401ks. Or the medical reimbursement. Yes. Set them up? No, but you can go where I get mine. That's why I pay. Amanda, get up here. Amanda's going to tell you about record keeping. Oh my gosh. Amanda, you're so quiet. Get up here. Get up here. Amanda is wonderful. She keeps all of our realtors legal. Here, talk to these wonderful people about how they're going to do. She has a very soft voice. She has realtor CFO.
Hi everyone. So my name is Amanda, and I'm the bookkeeper at the office.
More than that.
A little more than that. So what I do is I get clients to come in, and I set them up with QuickBooks Online. I help them to connect all their bank accounts and credit cards to QuickBooks Online. It downloads all their transactions, and I go ahead and I categorize. So I categorize your advertising, your marketing, your auto expenses, staging, open house, all your expenses. I categorize it into different categories, and I categorize your income. At the end of the year, you're going to have your income for the year, all your expenses, and then your net income. It's a profit and loss statement. That's what you would take to your accountant to get your taxes done. Now, I bring you to the office and I set you up. And at the end of every quarter, I would send you an Excel spreadsheet of your uncategorized checks. Now, even though some of your bank statements at the back of it has your checks printed out, not all of you may necessarily use the memo line to put, you could have paid Linda DeMala $500. Some people write in the memo line, this was for accounting services. Some people leave it blank. So I'm not going to know what that was for. So that I would ask you at the end of every quarter. I'm not going to bother you, every week or every month. And there's some expenses that I won't be 100% sure of. Now, 90% of my clients are realtors. So I know generally what realtors spend their money on. So I'm going to automatically categorize it for you. So at the end of every quarter, you'll get that Excel spreadsheet with few transactions that I'm not sure of. At the end of the year, I'll ask you for your 12 months bank statements. I'll reconcile your accounts for you, and I'll give you the P&L. That's what you take to your accountant, and you have your taxes done. So right now, I'm running a special for realtors only. It's usually $500 per quarter and $500 to set you up and get you going. I'm doing a 50% off. It's $250 per quarter going forward and $250 to get you set up. Now, I also can just charge you $250, set you up, and give you 3 months assistance, the first 3 months assistance, and sort of just help you to navigate your way through QuickBooks Online. That's not a problem. I've done that for a couple of people. They all come back to me a month later, and I can't do this. It's driving me nuts. Now, as realtors, you don't want to be stuck behind a computer trying to categorize line by line by line. This was auto. I spent $37.05 at the Shell gas station. You want to be out there getting your commissions, getting new clients, showing houses, being out there in the field. So you don't want to be stuck at home, or in the office sitting behind a computer doing this stuff. That's where I come in. This is what I specialize in. So yeah, you just, want to sit back and, be out there. I'm the one that's going to sit back and do the work for you. So, any questions? Yes, the blue card is. So, check the box at the bottoms. Either myself or Kareem will give you a call back today to set you up with an appointment with Mark Moninger. He's the 401k guy. We can do. He doesn't. 15 years.
He got me 23.11% return on my money last year, and I've only been working here probably 8 So he has to be more conservative with me. The younger people got more. He's a certified financial planner with LPL,
Financial.
And there's billions of dollars under. You're not the only client that we got out. By the way, he's not really coming. Oh my gosh, you must have at least 1,000 realtors.
Yes.
At least.
More. Yeah.
There are no legal requirements. An LLC, you just form it. That's it. Corporation. No, you don't. There's no meetings. That's it. Nothing else, except that each year in the state of Virginia, we'll have to file a little form saying that you're an LLC. But you don't have to. You just have a separate bank account. You don't have to have meetings. You don't have to pay yourself a salary. You don't have to do anything. An LLC. Yes. Okay. If you you own a rental property, who manages it? Rental property company. Okay. The title of my opinion, not a lawyer, but they owned it. The title of the property. And then, God forbid, if you get sued. But they're going to write a check to you, and that money better go into your LLC. Because if you touch it, property, yes. Yes. Otherwise, if something goes wrong with one property, you can lose in all of them. I've seen it happen. I've helped clients sue lawyers who did it to them and win. We always win. I always win. I never lose. Real estate practice. It's a bank account. That's all there is. It's a bank account. It's only if you elect to be taxed as a corporation that we have to do we have to do an extra tax return and we have to do the salary. That's it. Think about it. Time to start thinking about it. Yeah, you might have reached that point. You had a question? Yes, sir. I want your last year tax return, and I'll tell you. Okay, if you're making over $150,000 a year, I'll let you think about being an S corporation. Before that, don't even think about it. There's so many other things we can do. First, we're going to do the medical reimbursement plan, because that's the big one. Huge, huge. Yes, yes, yes. LLC, sole proprietor. It's complicated. You know, each of you is very special. Each of you is different. And each of you is a realtor. And unless you have someone who deals with hundreds, preferably thousands of realtors every year, nobody will figure it out properly. We are the best at what we do. We don't need your money. I don't need you to be my client. But please go to somebody who knows what they're doing, because they're just going to have you pay too much tax. Okay? Yeah, I can give you so many examples. Every time somebody comes in where they've done their tax return on TurboTrash or something, I get out the red pen and I start circling all the mistakes. Here's all the money we're going to save you. And we're only allowed to go back 3 years to change it, to get your money back. So if you've been making mistakes for more than 3 years, we can't get the money back. And the medical reimbursement plan, you can't go back. It starts the day you sign the contract. So we'll never get that money back that was lost, ever. Awful, awful. Yes, sir. Andy, too. The 20% pass-through starts this year. Uh-huh. Yep, yep. 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 Now, if you're going to be yeah, it gets you a little more complicated, but yes. And you can be an S corporation, or you can be a sole proprietor, and you can be, of course, an LLC. Yes. Good questions. If you have a regular LLC, how is it taxed? Is it taxed as a sole proprietor or a C Corp or an S Corp? You have to elect one of those three. Yeah. Yeah, usually it's just a sole proprietor. 99% of all the LLCs are just sole proprietors. Yes, you can. Oh, yes, absolutely. They were invented for farmers. Farmers, do you think farmers even knew about LLCs? They didn't even have LLCs back in 1955. Okay, they didn't even exist. In Maryland, we didn't have LLCs until October 5th of 2005. Yes, you're Jeff. Hi, Jeff. Oh, a partnership. Oh. Now, it's not because I've been divorced 5 times, but there is a problem with partners. Okay, so you're in a partnership. You can elect to be an LLP. So you can be a limited liability partnership. Okay, but you are still responsible for everything your partners do. Be careful. Okay. Get a good lawyer who's going to do a joint venture agreement, because what happens if one dies or one gets divorced or something else happens, one gets sued? You want a really good lawyer to set that up. Yes. Yes, I don't have a Virginia lawyer that I do have okay, there isn't one. Okay, my daughter will know. My daughter is licensed in Maryland and DC. She has some Virginia lawyers that she recommends, and I would tell you to talk to her and tell her what you want, and then she'll tell you what to go. And she won't charge you for talking to her on anything. You tell her you had to listen to her mother, to listen to mommy for an hour. By the way, you all need wills and estate planning too. Okay, we'll talk about that one too. Rob, you've been so quiet, but I didn't bother you because you were so nice to push the buttons for me. Any questions? The home office, yes. You can decorate it. You can decorate your home office. You know, you can deduct up to $500,000 this year for decorating your home office. And by the way, those of you who are just starting out, this is your first year, you want to make sure you have all your deductions for last year, even though you had no income, because all of those deductions can be used to wipe out either income from a spouse or income from your other job, or if there's no other income, we can carry those losses forward for many years and use them up. So the losses will not get lost. So just because you didn't make any money, don't think you don't have to file. You need to file to memorialize those losses so they can be used against other income. Either in the past we can carry the loss backwards or we can carry it forwards. Decorating. An office that you rent, fully deductible. You can buy a flat screen television for your home office or the office that you rent, either one. Yeah, all office decorations are deductible, up to $500,000. If you spend more than $500,000, we're going to have to depreciate it. She's going to keep her decorating budget. Good girl, Kayla. Yeah, the question. Very quiet also. What can I help you with, hon? Oh, you have an app? What's it called? Mile IQ? Turbo Trash? Oh, TaxBot. Oh, it goes down. We just got a new client. Amanda just got a new client last week because they had all their information on that and it crashed and they lost everything they had done for last year. Everything. And this guy's a really smart engineer, so he didn't do anything wrong. It just crashed on him. Don't do that. Yeah. He lost everything. And it's not You need Amanda. Amanda's the best. Yes. Do we do appraisals on rental property? Components, by the components. Yes, absolutely, good idea, because you can take different depreciation methods. Yeah, it's 27 years on real estate, whereas if you can get something out that's not 27 years, only 5, then that's even better. Yeah, very good. Yeah, oh, finally, a question, and then you, yes. Oh, so you go from Alexandria to here. Wow, okay, yes, it's because you see your home. That makes it deductible. Yes. You've been putting them down as personal because, oh, it's your first year. Well, now we're going to go back and we're going to memorialize all those trips, aren't we? Yes. Did I see a question back here? No? Okay. Keep going. Oh, can I explain more about carrying losses forward? Yes, business income, it's called a net carryover loss. Now, the old law, which was in effect, said that if you had a loss in 1 year, let's say we have somebody who really started real estate at the beginning of the year and they didn't have any salary or anything else. Let's say they only made like $10,000, but they come to Tax Masters. We found $15,000 worth of business deduction. So at the end of the year, they have a $5,000 loss. We have a choice. We could carry that loss backwards to 2 of the previous years when they had higher income and were in a higher bracket and get them an immediate refund, just like that. Or we can elect, maybe they've already had a lot of settlements coming up forward, so we'll just elect to carry that loss forward to reduce their income on next year's tax. Yes. Well, it's not on Schedule C. Good. No, don't put things on Schedule C. No, you want to put it where it'll do the most good. It'll do the most good on another schedule. No, don't you tell me schedules. I'll tell you where to put it because I'm always right. Don't put it on there. You'll lose all the benefit if you stick it on there. Yeah, Mary is wonderful. Mary, she's really good, especially with my rookie clients. She gets them started. She's like tax mommy. I call her the tax mummy. But if you fill out this form, did everybody fill out the little form so they can be on my list? Did you fill it out? Where is it? Give it to me. Yes, very good. I love obedient men. Just ask my 5 ex-husbands and my fiance. Oh, of course. Somebody has to cook for me. I can't cook. Somebody's got to take care of me. I'm hopeless in the kitchen. Completely. Yeah. Okay. And Evelyn, tell me about Evelyn. She does a good job helping you.
Odds and ends. I've been paying all of her dues and everything else. I paid her salary.
Oh, now you have to give her a salary, just a little salary. You know what's funny? Marty, Mr. May here, Marty's wife was a realtor when a long time ago when he was, he used to be an engineer before he became a tax accountant. And his accountant, and he used to stuff envelopes and run errands and pound signs. And his accountant at the time never had his wife Diane hire him. And he says, all those years, I stuffed all those things and drove all that stuff around for Diane, and I never got a paycheck. He still hasn't forgiven his old accountant. So when he came to work with me and I explained the law, which nobody knows about, he said, oh my gosh. So he's in charge of it now. He jumped on it with 2 feet. Yeah. Do you have a spouse who helps you? Oh. And then you have children. So are you looking at orthodontia or anything like that for them? Because there's medical bills. Oh, good. Oh my, and your accountant never told you about this law? No, he took it off as a personal expense, which means you lost the 10%. Yeah, I'm so sorry. But let me tell you, the problem with that, it was deducted as a personal expense, which only saves you federal and state tax. You move it to the business part of your tax return, it saves you federal, state, Social Security, and Medicare. So it saves you 15.3% more just by moving that one number from here to here. Plus you lost 2% of your income on this one. Here you get all of it. Huge difference. Oh, okay. You'll get to talk to Marty. Oh, he'll like you. He's kind of prickly. Yeah. Jeff, did you have any more questions, honey? No, okay. Well, everybody's dismissed if they want to leave. I will stay and answer questions. Are any of the people who are so nice to watch online, do they have any questions? Do they want to type them in? Would you like to read them to me, or you want me to come over there and look at them? No questions. Okay. Okay. No questions. We can go back 3 years to change things. That's the most we can change, is 3 years. You know, unfortunately. I wish we could do more. Everybody who comes to see us brings us all these awful returns that they did themselves or that some stupid accountant who didn't know what they were doing. Sure, absolutely. Oh, yeah. Oh, but then we cry. Yeah, well, you know, sometimes there's a way you can move things forward too. It depends on what kind of deductions. I'll tell you the most important thing is if somebody owns a rental property, because 90% of the time the depreciation